Hey, so welcome to part three. And the third type of arbitrage is called triangular arbitrage. And it's typically found in currencies where a lot of these institutions...
Nobody cares because nobody can use your institutional bullshit. Why can't you ever do anything to help out the retail trader?
Okay, fine. Even though the stuff I talk about is mostly about structure and how you can apply it to other aspects as well, I'll talk about something that everybody has access to. Crypto. If you're new here, or if you're old, you'll know that it's not that I dislike crypto, it's just that I dislike a lot of the loudest voices behind it, if that makes any sense. And honestly, if I'm going to dive into this, you better subscribe and or convince someone else to subscribe to my channel for doing this. So triangular arbitrage is, as the name implies, you're taking something like Bitcoin, for example, right? And then you're converting it to Ethereum, and then you're converting that into XRP, and then you're converting it back into Bitcoin. It's a huge round trip, and hopefully by the end of it, you end up with more than you started with. The formula is fairly basic for this thing. You got the amount of Bitcoin you have times the price to get the dollar denominated value, and then you divide it by the Ethereum price to get the X amount of Ethereum you have. And then you keep doing that so on and so forth into XRP, and then finally back into the round trip of Bitcoin. Now, if you saw some of the previous videos where I drew like two parallel lines next to each other, and anytime there was a slight deviation, that was a momentary opportunity where you can take advantage of that pricing discrepancy. This is basically the same thing, but now there's three parallel lines. And the reason why there's three, and the advantage why there's three, is that instead of just having the two variables up and down, you now have three variables, which causes even there's the probability of you actually getting and finding sort of discrepancies and mispricings is a lot higher. And to kind of pull in what I said from the first video from pure arbitrage as well, you'll probably likely do this with like separate exchanges, like two different venues, three different venues, or whatever, right? So the mispricing possibility is even higher. And the beauty of it is if they're more, unfortunately, crypto is not really centralized, but if it was more of a centralized exchange, it would kind of try to realign with that symmetry in price. Therefore, you know, the probability of, like, essentially what's going to happen is that you're going to buy in one, sell in the other. One will lose like maybe $1 in that exchange, but the secondary exchange will gain $1.20. And essentially that 20 cents is your net profit. Now, unfortunately, because I'm me, I have to talk about some of the risks for the situation. And first one being is it's really competitive. There's a lot of smart people out there. It's complex, don't get me wrong, but there's a lot of smart people out there that are taking advantage of this that have like a huge edge, especially in terms of speed. Second, you can't guarantee fills and or essentially slippage and stuff like that, right? And that will eat into your profits. That is a reality within the real currency trades as well for this type of arbitrage. The third thing is, I kind of escapes my mind right now. Okay, I just remembered. The third thing is basically commission and fees and whatever that sort of stuff, right? That is stuff that you have to factor in as well, because a lot of the crypto exchanges nowadays are charging like, you know, 0.01 or something gross. It's actually a lot more than what you would pay in the regular finance world, which is surprising. Listen, bottom line is, I know that arbitrage trading is typically synonymous with HFTs, but I'm not saying that you can compete with them. I'm not saying you can't compete with them either. I'm just saying that these HFTs have bigger resources than you do. And I'm not saying that you can't capitalize on certain opportunities outside of the traditional market. Arbitrage is always something that fascinated me, and I like the idea, and I think that a lot of people misunderstand that idea of how it has to be applied to solely the stock market and so forth, right? It could be applied to outside of the stock market in different markets and even in the real world applications, similar to what I showed in the first video with the online retail arbitrage. I guess I just want to say, just because it doesn't work in one area doesn't mean it's broken or too competitive. You just have to look through other greener pastures. Just like how just because you're a day trader doesn't mean you have to trade every single day.